Muy buenos días a todos. Mi nombre es Guillermo Almazo, soy Publisher and CEO de Inmobiliaria Magazine. Es un placer para todos tenernos ustedes en este cuarto día de actividades. Llevamos ya más de 80 horas de transmisión con los paneles de discusión que hemos trabajado para ustedes y que van a estar on demand hasta el 31 de diciembre. Llegó el día de tener nuestra conferencia magistral y es el Día Internacional para B2B Media USA LLC. Es un tema importante el que vamos a tratar el día de hoy y por eso logramos convocar a grandes speakers que tenemos aquí en Estados Unidos. Voy a cambiar en inglés porque este panel va a ser en inglés. El tema principal es oportunidades de inversión en Estados Unidos. Créanme que el mercado y los ciclos del mercado inmobiliario cambian y van evolucionando y se ha cumplido, y con esta pandemia hay cosas que, como el e-commerce y la tecnología, aceleran estos procesos. Y para eso logramos tener aquí un panel de expertos, el cual nos dará una cátedra de información de lo que puede haber de oportunidades con todos los activos inmobiliarios que están en distress. Voy a presentar a Nitza. Nitza Soledad, ¿cómo estás? Buenos días.
Buenos días, Memo.
Nuestro amigo Ralph Stavin. How are you, Ralph?
Excellent. Hola, everybody.
How are you? I'm going to Javier Yuch from Element Development Group. Javier, ¿cómo estás?
Good morning, everybody. Buenos días.
So, I'm going to turn this to Nitza, and I'll give you a quick introduction, and good luck. I'll be back to you in half an hour. Good luck, Nitza.
Thank you. Well, good morning to all our viewers. This panel will be about how to invest in a distressed real estate market. As Memo mentioned, my name is Nitza Soledad Perez, and I am the Miami correspondent for CGTN America. I'll be your moderator this morning. And joining us is the CEO of Element Finance Group, Ralph Stavin. He is our expert in-house, and he will try to explain to us this very complicated situation. Just so you have an idea how we'll proceed this morning, first, Ralph is going to give his presentation. Then I'm going to have some follow-up questions. And finally, I will be reading all your questions on this panel that I have on the right side of my screen. So please don't be shy. Write all the questions either in Spanish or English. Memo and I will be translating, and Ralph will be answering for all of us. And, well, Ralph, the screen is all yours.
Hey, good morning, Lisa. Thank you so much for the introduction. My name is Ralph Stavin. I've been working in the distressed asset and loan market for about 25 years. In that time, I've worked for several government agencies, including the FDIC, SBA, and HUD. I've also done work for hedge funds, banks, and individuals and institutions. In saying that, I've performed services on due diligence, acquisition, management, which may be the most important part, and the disposition of the asset. So all phases of the distressed asset world I've worked in, and I've worked for many of the biggest government agencies at that time doing these jobs. All told, I think I've been involved in about over $10 billion of management and disposition of assets, which a lot of it was done during the last recession. I was working as a vendor for the FDIC, so I saw everything go wrong that you can imagine. But I also want to preface this presentation with saying that even though we see a lot of malinvestment in the real estate world, there are also many, many excellent originators, operators, lenders that have done excellent work on their due diligence and their preparation, and their deals are really well done, and they're not going to be the assets we're going to see in jeopardy. But we are going to see deals that were done in the last 5 years that didn't make real economic sense. It's just the interest rates were so low, the operators and borrowers couldn't resist doing the deal. And in times of stress like we're seeing now with dropping rents or vacancies or people just not even able to pay on small business, medium business, and personal level, the numbers were so tight to make these deals work that 6 to 9 months of a drop of 10, 20% in revenues is enough to push them into default. So once again, I want to say that this is a time of opportunity that we see. This is not a time to talk down about the market. We're looking for opportunities to buy assets at a price that gives us an entry where our success is a lot greater. When you're buying something at the top it's ever traded, it really can go up more, but obviously the downside risk is greater. We're looking to get it in a lot lower cost basis, and those opportunities are going to present themselves in the coming months. So But the first thing I want to talk about when I look at the debt markets is the United States debt market. And the United States debt market has a couple major players. The first one is government debt. I think we're all aware that government debt is pretty high. Obviously, the government is being forced to borrow a lot of money to cover the COVID expenses for a lot of the nation. The second one, which is our main category, is commercial debt. We are focused on commercial debt backed by real estate. That's our focus, be it loans or assets. We want commercial debt backed by real estate. I want to show you slide 1 here. Slide 1 shows you, and you can see the 2009 downturn in the gray area far to the right. And then since the 2009 downturn, basically the market has just accelerated to the upside, and that's the loan volume. You can see how much the prices in the volume has increased. It's really, really high. And obviously, like I said, because interest rates are so low, a lot of deals were done solely on the basis of the low cost of borrowing money. Those are the deals we're looking at. Next slide. If we can go to the next slide too. All right, this slide is when we talk about the debt to the United States. This is the personal consumption and debt slide. So this is an individual, a U.S. individual's total debt load. Once again, we can see we're at an all-time high, and that includes mortgage debt, credit card debt, auto loan, credit card, student loan. I'm only showing this slide because the U.S. consumer is about 70% of GDP growth in the United States. So we can see the U.S. consumer debt is at an all-time high. Bank loans, all-time high. Can we return? So we combine those two things, and we're kind of setting up the table to show that U.S. debt is at an all-time high across several levels. So the next topic we're going to talk about is the interest rate environment, and we touched a little bit on the debt load. Interest rates almost across the world are at an all-time low. And while this is great for borrowers, obviously funds or people that rely on interest rate debt to fuel part of their investment objectives, they are being forced, because of low interest rates, to take more and more risk to get a higher interest rate. Now, while that seems hard to quantify, if you follow the American junk bond market, you can see I've sold junk bonds for part of my life. I was a bond trader. We used to sell junk bonds, non-rated corporate debt. On a 10-year, we'd probably get 8, 9, 10% we'd sell it for. Now, a non-rated junk bond sells for 5. But what that shows is the risk of a junk bond is still very high. When a junk bond defaults, you probably get no cents back on the dollar. You're wiped out, just like a stock. And so when people are forced to take on a lot of risk for a lower yield, they're making really speculative bets in debt in the bond market. And the other side of this is that
the price of the real estate.
Well, the price of the real estate, one of the things about keeping interest rates low is it spurs investment in things like real estate, which pushes the price of real estate high. The stock market's at an all-time high. People are getting into speculative investments, hoping to get some return because they're not going to get it on their debt investments. So slide 3 will show us the interest rate environment across. That's the Fed funds rate, which sets the U.S. interest rate. You can see in 1990 or 1980, it was as high as almost 20%. Right now, we're at 0.25%. So historically, we are at historic all-time lows on interest rates. And this is the current Treasury yield curve. Obviously, it's a couple days old. I think we're actually lower. You can see the blue is the most recent. A 10-year is yielding on this about a 0.8. I think we're down to a 0.7 now. So Treasury yield curves have even compressed since this. But one of the things about having interest rates so low is that it does spur operators and borrowers to do deals that they normally wouldn't do because the interest rates are so low that they basically can't say no to doing a deal. I was looking at a defaulted deal about 2 weeks ago. It was $230 million, mixed use in the Northeast. It was a 5-year loan, and the interest rate was 1.5%. and they're in default. So I don't know who would let someone borrow $230 million at 1.5%, but basically for the borrower, he couldn't say no to that money. At 1.5%, it's almost free. So we're seeing deals get done that don't necessarily make perfect economic sense. So this next graph is the Green Street Property Index. Green Street is a quantitative group that tracks every commercial real estate deal in the United States, and they have for a long time. And right here, the top one is manufactured home. Obviously, it's taken off, but you can see from the 2009 downturn how pretty much every property sector, except now lodging and malls, has really, really exploded to the upside, almost double in price. This is the price indicator, not a volume. So this tracks the price per asset. So we're near an all-time high in a couple different sectors, and rightfully so. Storage is doing very well. Industrial is really, really strong. And this brings us to what we're really here to talk about is commercial real estate. The commercial real estate market. No, we'll wait on this one. We got a little while. All right, so in the commercial real estate market, we have basically lenders and borrowers. The lenders are banks, shadow banks, and I like to put CMBS in there also. But on the shadow bank side, it is a kind of a new phenomenon. With banks, we have highly regulated entities that have to do reporting every quarter that you can go see on the FDIC website. I live on the FDIC website at times, but we can look at their ratios, their loans, defaults, all different kind of numbers from the largest banks in America to the smallest. We can digest all of their ratios and get a really good idea of where they are right now in regards to loan quality, capitalization, anything else you want to know. Shadow banks, which include most hedge funds, private lenders, pension funds, insurance companies, these aren't regulated as closely, and some aren't regulated at all, unless they're publicly traded. Then they have to put in reports to the SEC. But shadow banking has exploded in the last couple of years, and they're sort of an unknown character. They don't have to report on loans. They don't have to report on loan quality. They don't have to report on the amount of loans that are in default or are current. They don't really have to do anything. That's their own private business, as it should be. So it's really hard to gauge the status of the non-banking, shadow banking part of our economy. During the last downturn, this was very problematic, and a lot of these entities are now called, I forget the exact word, but their designation is they're entities that are valid to the economy, and they are watched a little bit more closely. But still, a lot of them are left on their own. Now, the borrowers break down into a couple different sectors, obviously, and we classify them as multifamily, lodging, retail. And we showed you that Green Street graph. A lot of the sectors are doing well, but we've already started seeing a couple sectors, specifically retail and lodging, which are hotels, are starting to show a lot of cracks. There's anecdotal evidence, and I've seen a couple deals start to hit the street where the prices are a lot lower than they used to be. I don't think they're where we're going to see them ultimately, but they're starting to sell. All right, so we've covered a couple different things. And once again, I want to say that this is a moment of opportunity. If you've been making money on the upside of real estate, which most of us have, this has been a good 5, 6, 7 years to make money on the upside. You need to take a good look at what we're saying. You may not believe it. If you make money on the upside, sometimes it's hard when someone tells you that a recession is coming. I understand that. I've been in this side of the business for long enough to realize that that is tough for some people to swallow. But saying that, not every deal is going to go into default. There are a lot of excellent operators out there, excellent lenders who are going to do perfect jobs on their deals, and they're going to survive and thrive. I am never going to get a chance to buy those. But there's also a lot of deals that have done just because of low interest rates that the numbers are so tight that we're going to see opportunity. And we like to think that there's opportunity in both sides of the market, the upside and the downside. The bull and the bear. There's been a bull market for 5 years. You need to look at what you have. And if you certainly see things the way I do, and maybe the way it may be, it could be some asset classes don't get affected I understand that. But certainly you need to look at some of this and protect yourself against some of the downside that may come. And that's what we want to do, preservation of capital and to profit on the downside and reset our cost basis at a much lower level. So when it is return to normalcy, we have profits, big profits. And that's what we look at, which kind of takes me to this second part of this presentation, which is we look at recent developments in the market and COVID. I think we're all acquainted with COVID. Prior to COVID in early 2020, some of the sectors of the market started having some shakes. And this was predictable because we were at an all-time high in pretty much every market. Real estate market all-time high, stock market all-time high, bond market all-time high. And just keep going to all-time highs. It almost defies explanation. That's the upside, but we started seeing some cracks. With COVID and the quarantine times, which may be, unfortunately, coming back because I really want to travel, we may see a lot of restrictions. Europe is under, England just shut down again. Paris, a lot of the big cities are shutting down. We're seeing the numbers explode even today. But that type of shutdown in cash flow, when you have a mountain of debt that we have, commercial and personal, all-time highs, I show you the graphs, they're not mine, those are other entities. Any sort of cash flow reduction or hiccup is going to throw a lot of that debt service into default. Right now, there's a concerted effort between banks, the government, to try to forbear and allow these people to return to normalcy and bring these accounts current again, which I appreciate that because most of these firms, small businesses, shouldn't close because of this. A lot of them are in jeopardy, we know that. So COVID has thrown the whole cash flow matrix of our economy into a funk. And a lot of things aren't going to survive that. It's already been 6 months. It looks like it may be extended. I know it's tough. I think we're all dealing with a contraction of our life, our lifestyle. But when you have deals priced to perfection in every sector, a 6 to 9 month reduction of 20% in cash flow, just 20% reduction in cash flow is enough to push many of these borrowers into default. And can we check out slide 6? This is the recent development that came out of, that one right there, that came out of REA Partners. They're a very big analytical real estate firm. Now in this chart, the blue line is the prices asked for Manhattan office space. This is just Manhattan office space, which is a heavily traded market. It's not a bellwether for every market, but certainly will show us what's going on. The yellow line is what buyers or renters are willing to pay for said assets. The blue is the ask price. The yellow is the bid price. It's almost a 30% gulf in what people want to sell for than what people are willing to pay for. This is the end of the seller's market in commercial real estate office space in New York. I'm not going to say it goes a lot farther than that, but I believe it will. We're starting to see a gulf between bid and ask, which means those sellers are probably going to have to come down at least halfway, maybe more, to meet where the buyers are willing to go. All right, let's get out of that. Go back to the front here. So one of the things a lot of my people that I talk to want to know is why do lenders sell loans and conversely REO? They have to sell REO. They can't own it. They're not built up. But in good and bad times, a bank and a shadow bank will sell loans. They sell loans all the time. There's a very active secondary loan market. And for the most part, all these loans are performing. The last 7 years, they've all been performing. But banks will, just like any good investor will, they will use risk management to look at their investment portfolio. Let's say they have 20 mall loans. They'll say, let's say sell 4 of those. They have gas station loans here. We'll sell all those and make new loans. So banks and lenders are always selling loans. In times of stress, however, regulators will force banks to sell loans. And non-bank lenders will usually sell non-performing loans because they don't want to go through paying the legal costs of foreclosing a loan. A lot of lenders would rather get rid of a loan before they have to go into legal. It's not always possible. 4 minutes? All right, so the secondary market is very active. And right now, the secondary market is really starting to hook up. Now, when a bank does take a loan to REO, that means they foreclose out the borrower. They want to sell that loan as fast as possible because a bank has to have any sort of loan that's an REO has to be fully paid for. That means it eats away from their capital to lend more. Banks hate that. So they try to sell REO as fast as possible. Not always easy. I've worked for many banks selling REO. All right, so is this an opportunity to invest? This is the big one. Starwood has just raised 11 billion and BlackRock has raised 23 billion for distressed debt investing funds. Now, Starwood and BlackRock are two of the largest lenders and real estate operators in the world, probably combined own over $1 trillion worth of real estate stocks, bonds. These guys make money in up markets and down markets. If they think that they should raise $40 billion, $30 billion approximately to buy distressed assets, and I've sold stuff to both of these groups, they see something. And these guys make money in both markets, up and down. They're preparing themselves for the opportunities to get into distressed debt and REO. That alone should raise your eyebrows a little. When big guys are doing it, these guys know something usually. They don't do stuff to lose money. So we believe that given that the institutions like these two, BlackRock and Starwood, they look for large pools, billion-dollar type pools. There's going to be a chance for boutique groups, smaller groups, 5 to 25 million, to get into the market and find assets at a much lower cost basis. And that's where we want to be. Okay, so what does it take to be involved in the distressed asset market? If you're a businessman and you've run a small business and developed something, you already have the skills. You've already fought adversity. You've already had to make things work, jump through hoops, never sleep at night, make it happen. You have the character already. One of the things that we like to say is that to be invested in distressed real estate, you have to have a good partner who does it full time. You have to have great due diligence, active management, and above all, principal protection. When the principal we spend is the most important money we spend. Upside is great, but losing money to us is more painful. We like to make sure capital preservation is that key. So we manage our properties on a daily basis, and that's what you need to do to be invested in distressed debt, especially at the beginning. One of the things also when you buy distressed loans is you can't be afraid of the legal avenue, because there will be times where you will have to foreclose out a borrower and fight them in court. I've had to go through many of these scenarios, and I've had easy battles and terrible battles. But the one thing I've always found that a good attorney, and I have several, that will help you through these things, they're worth their weight in gold. Just to read the loan documents alone, have them, their professional abilities reading loan documents saves you so much headache and future liability. So to invest in debt, you need to have the attitude that you can do it. You need to have a great partner who's actively going to manage and is going to protect your principal and capital above all else. And you cannot be afraid to enter into legal. It's something we have to do, and it's hard to quantify. So saying that, once again, this is an opportunity that's going to present ourselves. We are going to have a chance to buy assets at a much lower cost basis than they've sold in the last 5 to 7 years. We believe that with the right management, the right exit plan, the right strategy, that these can be incredibly lucrative opportunities for investors to capitalize on the downside of the market. This isn't the time to run. This is the time to step up and find these opportunities and grab them, because they may not come again for the rest of our lives, because this is the second time we've done this in the last 15 years. Hopefully we don't see this again. You never know. There's a lot of risk in the economy. But once again, I want to say that there's some great operators out there who do amazing jobs, and I wish I would see some of their properties. I never will. But there's also a lot of deals out there that were done that don't make really good fiscal sense, and we're going to see those deals come up. And those are the opportunities we want to grab at a much lower price, so the revenue that the deals do make is enough to exceed what we want to make and then grow it and reposition it. I think that's it for now. I know I covered a lot, and I have a partner, Javier Luch, here. And you can see him right here. If you have any questions in Spanish, Javier has had to listen to me talk this language for years. He's pretty well acquainted now. I think he can translate anything we have on questions to answer. So let's get back.
All right, now I'm going to take over with a few questions for you, Ralph, and then I'm going to open it to our viewers.
Excellent.
First of all, interest rates are, as you just mentioned, at an all-time low. So shouldn't it be easier for all this debt to be surfaced in this environment?
You know, it would be, but the interest rate is not the only problem. When you have defaults on a large basis, you have the borrowers are defaulting. The lender, before they do anything, will call for an updated valuation appraisal. And so these deals, when they were put out they had a debt service coverage of 1.2 to the lender. That means they were supposed to make X amount of money to pay their loan back. And then all of a sudden it comes out and they're making X minus 40. So when the valuation comes out, they may have a loan for 100 million, and that was the original valuation. Now it's being valued at 50. So it doesn't matter. And this happened tens of thousands of times during the 2009 recession. This is what I dealt with, was these properties were worth half of what they were originally lent at. So what happens during the valuation when it comes out, because they're not making the money they projected, is that it's half. The person who borrowed the money to make the project has already lost all their equity in the new valuation. They walk. And so what you have is cascading defaults in areas and sectors where all of a sudden my competitor who just had this property valued at X, I have 10 of these. You see a downdraft in almost all classes around those areas. Miami suffered from this greatly. So did most big cities, as assets were revalued on cash flow, not on projected cash flow with the loan. And it definitely causes problems. So interest rates are only part of the issue. Problem is, if you're not making any money and you have no cash flow, it doesn't matter what your interest rate is. Also. Now,
for regular mortals like we're not experts in finance, what is the federal fund rate that you mentioned in one of the graphs?
This is the kind of a weird one. You don't learn this one in school mostly. The federal funds rate is the interbank overnight lending. Okay. It's what banks charge to lend to other banks. And it sets the basis for all interest rates up the curve. So it's overnight lending bank to bank. And then you go to 1 day, 2 day, 1 month, 3 month, 1 year, 3 year, 5 year, 10 year, 30 years. So you get that curve of interest rate.
All right, but why is that important for me as a consumer or as an investor?
If we go back to 1980, the Fed's funds rate was 19%. Right now it's at 0.25%. So every other interest rate is built off the Fed funds. When it's this low, every interest rate stays low. It's the benchmark. It's the benchmark. It sets the lowest, safest interest rate. Everything else, the interest rate goes up from there as you look at safety and time. So basically you graph it out. This is the time graph like that. Normally, sometimes it'll invert, rarely. Normally it just kind of goes out to 30 years. So it sets the basis for all other interest rates that we all pay.
Another term that, if you can clarify for us, when you were talking about the CMBS lenders, you mentioned bucket or trenches.
Could you bring up the slide for me? All right, so CMBS lenders aggregate loans from many different banks and non-banks. So right here in this slide, this is one I love. So you can see that on the far left, the B, that doesn't stand for buyers. That's the rating of the loan. B, which is non-institutional, almost junk. So what a CMBS lender does, it collects all those B-rated loans, piles them together, and splits it up into sectors called tranches, AAA, AA, single A, triple B. There's our B down at the bottom. They effectively turn B-rated paper into industrial grade AAA rated paper, basically turning lead into gold. And the way it works is the first losses are taken by the unrated tranches. And then these guys take last loss. The credit risk is higher on the unrated and the yield is higher. You get a higher yield to buy the lower rated tranches. In the past, we've seen total wipeout of deals like this, where every tranche, even AAA, took 100% loss. The underlying fact is that a B-rated credit is still a B-rated credit, and there could be massive losses. Remember what I said about investors reaching for yield and not being compensated for their risk? A lot of CMBSs, when they go bad, not all of them go bad, once again, a lot of CMBSs are put together really, really well. I've done a lot of work. I spent a lot of time sitting in meetings with S&P and Moody's, looking at tranches and breaking them down. But when these do go bad, a lot of those borrowers who are buying in those bottom tranches suffer total losses. And we will see some of that again. Just the malls that are going into default are going to cause a lot of those borrowers to take total losses, especially on the low tranches. So I hope that describes it. You have basically a bunch of loans mashed together into a bond-like instrument that pays different levels of interest depending on how they're rated, with the highest rating being the last to get a loss. Bottom rating, if there's any loss, they're wiped out immediately. So.
Yeah, another question from your presentation. What are the different challenges facing a purchaser of a non-performing loan versus an REO?
Well, an REO basically is a straight real estate deal. Your due diligence is totally predicated on collateral. You do your phase one, your phase two, your financials, You look at the numbers, you visit and you do a site survey with competing properties. It's totally collateral based, and you have a lot more control over it. A non-performing loan, and I've done my share of loan review, you have to also do due diligence on the loan documents. Exactly how, because when you're buying a loan, you become the borrower. You step in for the bank. You have to know what rights you have as a lender, what your remedies are. Can you put a trustee on the property? A trustee runs the property instead of the borrower and make sure that the borrower isn't stealing, or we like to call it scraping the property, taking all the money and not paying any of the money back. So the court puts a trustee in place to make sure the property is managed correctly. I've done that many times. Big fan of trustees. So your due diligence on a loan, you have to do loan level document due diligence. You also have to do due diligence on the borrower, which we call the credit. You have to understand the borrower, if he's still involved, if it's a recourse. Recourse means that if the borrower defaults, we can go after him for the money. In the current environment for the last 4 years, most loans are non-recourse. That means if the borrower defaults, you only can go after the property. You can't go after the borrower on a commercial side. That's starting to change right now as banks are tightening their lending parameters. So on a non-performing loan, you got to do credit and loan level due diligence, which is a lot more intense, but still doable, and as well as your collateral level due diligence. So you have a little bit more work to do, and you have to be prepared to go legal. If you have to foreclose somebody or engage in legal battle with the borrower, you have to be able to prepare to do that, which not a lot of groups want to do, and I understand why.
But you've been saying that there are opportunities to invest. So where should investors look into this recession to put their money?
Well, that's the big secret there. Harvey and I spend half of every day looking at deals. Conventional deals on platforms, brokers sending them to me, deals off market, looking at non-performing loans. And I've still, and I say this in all due respect to everybody buying, I've still only seen a couple deals that make any sort of sense. I saw a deal I sent to Javier the other day, somebody selling a 120 unit condominium building in Bay Harbor, Miami on a 3 cap. And remember, once you buy it, your taxes are probably going to triple from where this guy owns it. So you're not going to make a 3 cap, you're going to be losing money. That's what we're still seeing. Although you're starting to see deals in hospitality and retail that are priced where you want them. The problem is there's been a life-changing move in retail. Is retail going to come back? I don't know. I believe hospitality will come back in most places, some places slower, because Americans like us are dying to travel. I am dying to get out of Miami. I think we're going to see a lot of stuff. I wish I was in Mexico City for this, believe it or not. I wish I was.
Now, as you just mentioned, this deal that you thought it was not worth it. So is real estate overvalued at this point in 2000?
We are at an all-time high.
Will that change with COVID?
I think it's changing already. It's changing already. I don't want to put too many things out there, but I am a news hound. I track real estate upside, real estate downside, default, foreclosure, news as much as I can during the day. And there's a lot of news coming out, and it's starting to get a little iffy as the forbearance time period is coming to a close on renters and homeowners that aren't paying, as tenants, retail tenants, are being forced to either give up their spot. I think we all can drive down the downtowns of our hometown and see empty storefronts, right, that weren't there 6 months ago. And it's sad.
Unfortunately, that is true. And one more question. How do you determine what to do with an asset in this kind of situation as we have now?
Well, the biggest thing to do is you have to have a timeline. When you do your due diligence, one of the parts of doing your due diligence is creating a couple exit strategies or likely exit strategies. We have to be very adaptable in times like this. Nothing you plan is going to work 100%. So as we do our due diligence, Javier and I like to plan a likely repositioning strategy. If we can get a hotel with big enough rooms, could we reposition it to assisted living? Could we take a mall with all that parking and build multifamily where it is? There's various things you want to always be looking at as a strategy. In saying that, timeframes on the coasts, during the last recession, the coasts recovered really fast. If you had properties in New York, Miami, you were back in business within a year. inside the country, it took 2 to 7 years. And some states have yet to recover. Rhode Island hasn't recovered. So you have to temper timeframes and due diligence with likely recovery scenarios and be very adaptable. But when you buy a property at the right price, it gives you a lot more room to move than when you're paying top dollar and you're totally need perfection to succeed. We don't believe perfection exists. We believe there's always going to be hiccups. So we want to buy properties where we have room for things to go further wrong, which can happen.
Definitely. Well, I'm going to start opening the questions for all our viewers. We already have a few. Let's start with one from Erico Garcia. He's asking how long it's going to take to go up the interest rates, 2 or 5 years?
Well, there's been such an issuance of debt by the Fed, and just in this recent COVID rescue, we issue over $5 trillion. And the Fed sets the interest rates for the rest of the country and practically for the rest of the world. And I don't foresee the Federal Reserve voluntarily raising interest rates because that will affect the debt that they have currently outstanding. So we're going to see a low interest rate environment for many years, if not decades to come. Just for the last 3 years, the U.S. have only been paying the interest rate on the outstanding debt. Today, we have $5 trillion more of that debt. Doubtful the United States will default, but it will need to devaluate the currency beyond what it usually does through inflation adjustments. Now, United States is in a financial mishap at this moment, but still is the least dirty shirt in the laundry basket. So when the whole world has 200 debt to GDP ratios, the United States has GDP production and a debt ratio that is less unhealthy than that. So we don't foresee interest rates going up, which is good in down markets and to spur investment in the future. What the Fed has locked themselves into has used all its monetary policy to foment the growth of the economy before these debt crisis. Now that we're going to foresee a debt crisis in the next year and maybe 2 years, the Fed will not have in its toolbox enough monetary policy tools in order to foment growth. And so the market is going to have to act by itself organically rather than have a push from the Fed. So it's not going to happen. What we're going to see, that's why this crisis is it's not a global or general debt crisis, it's a per asset and sector and per operator crisis, where we're going to see operators that took second best deals at overvalued prices based on performance, on perfect performance. We're going to see them default. And on the other hand, we're going to see professional groups that have done their diligence correctly to continue to thrive through this economic downturn. So it's not going to impact everybody. It's going to impact those who did not do their homework correctly.
All right.
Yeah.
We have another question. This one comes from Liz Gordillo. Javier, I think you will probably be answering this one. She asked,
in Spanish or in English?
It's in English, but she is asking how the situation with the interest rates and the market here in the U.S. is replicable in Latin America.
Well, I mean, the U.S. always has an impact in Latin American interest rates. That is a given. Though in each of our economies in Latin America, we have the habit of paying foreign debt by devaluating the currency. As the COVID has impacted many countries or most countries in the world, maybe just a few in South Asia have not been or have organized it well, they should see in their own countries default opportunities. either what Ralph explained before as the acquisition of a defaulted debt. So you buy the loan from the bank and you take care of foreclosing or reorganizing the debt with the owner or the debtor, or you acquire the asset that has already been foreclosed, has already been processed by the lender, and now you have an asset at deep discounts, and that's where we come in. So part of this business on the distress asset is your know-how, which you need to know what you're doing, and as you have heard, Ralph, he's been doing it for 25 years and has transacted over $10 billion in distressed assets. And second of all is the access to the deal. So whether you have the money and you have the interest to do it, you have to have access to those deals. And these deals don't trade in a stock exchange where you can just bid on them. This is a relationships deal. So when you have decades of relationships with the acquisitions and dispositions directors in many of these different financial institutions, you have first peek at those deals. So when Ralph talks about us looking at deals every week, the majority of people in the US are not looking at this because they're not getting, you don't make public your dirty laundry in your financial institutions. You bring it to those few that you trust they can close, they have the expertise and they have the funding to close them, and you bounce it back. And if they buy the assets, then deal flow continues to come. If they don't buy the asset because the price is still high and the bank is unwilling to negotiate it because it has either FDIC restrictions or just credit portfolio parameters that doesn't allow them, then they'll reconvene, they reprice the asset, and the asset usually comes back within a month or two at a better deal. And we're going to see that. The more properties that become on default, and the larger the defaulted credit portfolios of bank, the more need they will have to dispose and divest themselves from those assets. So it's inevitable. It's already happening. It was happening in 2019, and COVID accelerated this situation. So what we had over the last few years was a typical Latin American monetary policies where you inject a bunch of equity and liquidity into the markets, and everything looks very shiny. But the truth is that the fundamentals of these asset valuations do not meet the pricing that you see them on, and that disparity creates a spread that now it's going to correct. And we're here to not just benefit on the downturn, because we're not actually shorting these real estate assets. We're just negotiating them and acquiring them at either true valuation or at below valuation, which is our target. And we've done it before. We have acquired properties at 50% to their replacement value, and we're patient. We look at 3 to 5 year investment terms to allow the asset to yield its maximum potential benefit, and then we either divest from it or we refi the property, pay the investors their return, and we keep the properties. So I don't know if I answer your question. So we'll see it in other Latin American countries. There'll be defaulted assets.
One more from Rafa Romo. When do you foresee a rise in the real estate M&A market?
It's already happening.
Yeah. You want to pick this one? Yeah.
I'm assuming by real estate M&A, you're talking about M&A, mergers and acquisitions. You're talking about real estate focused companies, either brokers, owners, operators. You're already seeing a couple. I believe there was a merger of 2 very large assisted living facilities last week. Maybe a month before, there was a merger of 2 student housing facilities. Now, I find that interesting because both of those sectors are under real bad pressure. We consider student housing and assisted living, which I've worked both those asset classes. I love student housing. Haven't had as much luck with assisted living, but I've had deals I've seen that have worked for other people. So assisted living and student housing are considered multifamily by most people. They're multi-people living in the same unit. Student housing is usually owned by a university in the United States of America. About 20 years ago, a whole bunch of companies started making, so you have a university right here. Across the street, they would buy a huge lot and build a dormitory. Wasn't part of the university, but it was a student housing facility that was oriented towards selling it to those university students. Most student university-owned housing is decrepit. I've lived in it myself when I was a kid. So,
Yes, I know.
and I'm doing the college tour with my son, and a lot of the student housing is really bad. So these new buildings they're building, which are privately owned across the street, they're beautiful, beautiful setups, all different kind of amenities, pools, games, computer labs. You didn't have any of that stuff. So these type of properties are under pressure, and you're having companies that are doing well buying their competitors that are doing poorly. So we're starting to see M&A in a couple sectors like that. I haven't seen, there's always M&A between real estate brokers. I think you always see the companies shifting a little, but the asset management world of real estate, those are people that take care of properties. You've seen some M&A there. I believe BlackRock just bid for a real big analytics firm too. So a lot of the big hedge funds are looking at this time to grab companies they want that will support them in the next phase of the real estate world. So we are seeing some M&A.
There'll be not just real estate opportunities, but mergers. And when you see a merger, is usually more of an acquisition.
Yeah.
Without dumping the name and the trajectory of the company being acquired. And those who have not done their due diligence appropriately, they will be acquisition targets. And it's happening. You know, they'll have limited access to liquidity. In the United States, through many reasons, including the FATCA agreement and many other reasons, have become a dumping ground for liquidity for many countries for the last 5 years. And so there's a tremendous amount of liquidity like we had pre-2008. And that liquidity has shown to fall in the hands usually of very few players, especially when times of debt risk, like we're starting to see now, come ashore. And so we're going to see very few hands have access to a lot of liquidity, and many of the poorly managed operators, business or real estate asset operators, have liquidity constraints very quickly. And that will spur the M&A market.
Javier, tenemos uno en español. We have a question in Spanish, and I'm also going to translate it in English. Es buen momento para tomar un crédito en Estados Unidos para la compra de una propiedad. Y si uno ya tiene ese crédito, se puede reestructurar a mejores condiciones. La traduzco. Is this a good moment to acquire a credit in the U.S. To purchase any kind of property? And if you already have that credit, is it wise to restructure it under a better conditions?
Okay. Siempre que el activo tenga un precio y una valoración adecuada al mercado en el que se encuentra, es un excelente momento para entrar en una hipoteca a 30 años o 15 años si se quiere, pero que no tenga cláusulas de pagos de lump sum por menos de 10 años. ¿Qué significa esto? En muchas inversiones que no son first home, que no son la vivienda principal de la persona, y eso le sucede a cualquier extranjero que quiere comprar en los Estados Unidos, no puede declarar esa propiedad su propiedad principal. Por lo tanto, se convierte en una propiedad de inversión. Para ese tipo de propiedades, de second homes o investment homes, los lenders, los prestamistas, prestan bajo términos donde, a pesar de que el préstamo tiene una amortización de 30 años bajo el cual se calculan los pagos mensuales, te obliga el contrato de préstamo a hacer el repago o la refinanciación cada 5 años. Eso es un problema, porque al momento de la refinanciación viene una revaloración del activo. Y si estás en un momento de contracción de precios, ese activo no lo vas a poder refinanciar. Y por lo tanto el banco te va a pedir que le pagues la totalidad de la hipoteca. Entonces, sí es un buen momento para entrar en la adquisición de una propiedad a un precio correcto, pero siempre y cuando no haya una cláusula de repago por menos de 10 años. ¿Por qué? Porque tenemos la tranquilidad de esos bajos pagos mensuales por las bajas tasas de interés y no tenemos el riesgo del repago a los 5 años. En temas de, no sé si esto quedó claro.
Esa parte sí quedó clara. La segunda parte de la pregunta.
La parte de refinanciación, tenemos que estar conscientes que la curva de amortización de deuda es una curva, es un gráfico en cruce. O sea, al principio de los meses se paga 99% intereses y muy poco de principal. Y a medida que va pasando el tiempo, cada vez más se va amortizando principal. Una vez que se ha llegado más o menos al séptimo o octavo año, ya los pagos mensuales representan un monto significativo en el principal, en el valor de la propiedad. Y no vale la pena refinanciarlo porque vuelve a comenzar el cálculo de los pagos de intereses desde cero. Ahora bien, si
Javier, ahí voy a meter la cuchara yo. I'm going to interrupt you here. Porque si, me imagino que va a ser la pregunta de las personas que nos están viendo, pero si las tasas de interés están más bajas, ¿por qué entonces no me convendría reestructurar ese préstamo?
Los bancos calculan el repago de sus 30 años de intereses y los agrupan en los primeros 10 a 12 años de los 30 años de hipoteca. Durante los primeros años estás pagando solo intereses, no has amortizado principal, tú todavía no has pagado tu propiedad. Si tú vendes tu propiedad después del segundo, tercero, cuarto año de haberla comprado, te vas a dar cuenta que debes prácticamente la totalidad del préstamo que incurriste hace 4 años. Entonces, ¿qué pasa? La única razón para refinanciar es si este préstamo original lo incurriste a una tasa de interés del 6%, 7%, 8%. Entonces, entrar en una hipoteca a una tasa del 3% con el mindset, o sea, la estrategia de aguantar esa hipoteca por el resto de su periodo de 15 o 30 años, vale la pena. Pero no, si has pasado 7, 8 años, ya has pagado casi la totalidad de tus intereses de la hipoteca al 6% y vas a comenzar a pagar significativamente tu principal, no vale la pena refinanciarlo porque ahora vas a comenzar a pagarte. Cada pago mensual que tú hagas, la mayoría de ese pago va a tu cuenta, a tu favor, en la reducción del monto de la deuda. Entonces depende de cada uno de las hipotecas en particular que esa persona quiera refinanciar.
Entendido. Otra pregunta de seguimiento a este mismo tema de Liz Gordillo. En español y en inglés. Amazing explanation. Now, do these rules apply to all nationalities? ¿Aplican estas reglas que tú estás definiendo a todas las nacionalidades latinoamericanas, sean asiáticos, sea quien sea que esté invirtiendo en Estados Unidos?
Sí, en el mundo hipotecario, I'm going to say it in English, in the general mortgage market, in the mortgage industry, they have terms and conditions for U.S. citizens or residents and foreigners. And for those foreigners, the loan terms are usually very standardized for all of them. So when a foreign person or foreign entity buys a property in United States, regardless of their nationality, they will probably get same terms as a foreign buyer.
All right, and we have a challenger on the forum. He's saying, Carlos Fernandez, he's saying, the answer is, it's not the time to invest with a credit in the U.S. So, Ralph and Javier, we close with this. We have 5 more minutes. You have the challenge. We have someone saying, it's not the time to invest. Your response. And we got frozen. Oh, don't tell me we are frozen. Hopefully, I still have all of you, 500 viewers or so. Unfortunately, the feed for Ralph and Javier, it's not available at this moment. So unfortunately, I'm going to close the panel. I'm going to thank all of you for listening. I've learned a lot, and I hope you did as well. Muchas gracias a todos los que estuvieron viendo el panel. Desafortunadamente, se nos ha congelado la pantalla de Ralph y de Javier. Thank you, and please keep watching. Bye for now.
Hello. Nitsa. Hello. Nitsa. Hello. Hello. Are we done?